Welcome back to the deep dive. So if you are a business owner right now and, maybe you're doing $1 million, maybe you're pushing toward $30 million in annual revenue, you are in the middle of a very, very high stakes game. You are not just running a profitable company. You're building your primary, and let's be honest, often your only path to an 8 or 9 figure net worth.
That's the mission.
That's the mission. And the complexity of that, it comes with massive stakes.
It absolutely does. And the stakes are high precisely because that main outcome, a successful exit that secures that future, is so incredibly elusive. The critical point where most owners fail is it's in recognizing the difference between building a successful operation and building a truly sellable asset.
Okay.
We have to start with the cold, hard truth of the market, because that really sets the urgency for everything we're going to talk about today.
Okay, so let's unpack that. The wake-up call. Because this is where the urgency really lies. Most owners, they look at their P&L, they see healthy revenue, healthy EBITDA, and they just assume, right? They assume they've created this valuable asset that is guaranteed to pay them a fortune when they exit.
That's the assumption.
But the reality is much, much more brutal.
It is. The financial metrics give them a lot of confidence, but that confidence is so often misplaced. The shocking statistic, the one that should honestly send a chill down the spine of every owner listening, is that 80%. 80% of businesses that go to market never successfully sell.
Wow.
They either don't attract qualified buyers, or if they do, the valuation is so low, the deal terms are so awful that the owner just walks away with nothing.
So what percentage actually make it?
Only about 5 to 10% successfully exit on terms that actually allow them to realize the, multi-million-dollar wealth goal they were aiming for.
An 80% failure rate, that's not just a high number. That's a full-blown crisis that most owners just don't see coming because they're so heads down in the day-to-day. They think, if I'm making money, I'm building wealth. So what's the gap? Why do these successful, profitable companies just fail to sell?
It really boils down to one fundamental difference. It's a difference in mindset and then in execution. Are you running a JOB or are you engineering an asset?
Okay.
And the vast majority of owners, especially in that $1 to $30 million range, they build a job for themselves. A really good job, but a job.
They're the engine.
They are the engine. The chief decision maker, the chief salesperson, the chief problem solver, the relationship manager. They're the bottleneck. They're the absolute gravity center of the entire company.
You've painted the picture perfectly. The owner is the sun and everything else just orbits around them. The business is completely reliant on their presence, their knowledge, their willpower.
Right.
So when a buyer comes in, they look at the P&L, which might look great.
It looks fantastic.
And then they look at the structure of the business and they ask that one killer value-destroying question. What exactly am I buying if you leave?
That is the moment of truth. And if the answer is, well, you're buying a gaping hole where all the tribal knowledge, all the key relationships, and all the strategic direction used to be, then the value collapses instantly. Buyers are not looking for a great company run by a great person. They're looking for a great transferable company, a system, a machine.
Any proof?
They need ironclad assurance that the revenue, the clients, the operational know-how, that all of it will survive the owner's departure without a single interruption.
That distinction, transferability versus profitability, that's everything, isn't it?
It's the whole game.
If the business is inseparable from the owner, the buyer is basically just purchasing the chance to try and replace them, which is the highest risk imaginable.
It is. And risk in the world of M&A translates directly into a massive drop in your valuation multiple, a huge drop.
Which brings us to this trap that so many owners fall into.
The 3 to 5 years out trap.
Right. This idea that exit planning is something you do later. You hire a banker, you get your financials audited, you polish up the story a few years before you want to sell.
And that mindset is completely 100% backwards.
It feels like spending your whole life building a car and then only thinking about installing the engine 2 weeks before the big race.
That's a perfect analogy. Exactly. Exit planning is not about paperwork you file later. It is a business building philosophy that has to start on day one.
Day one.
If you wait until you're ready to sell, you might spend years trying to fix these deep, fundamental flaws, the lack of an org chart, no SOPs, and owner-centric customer base flaws that should have been engineered out from the beginning.
The goal isn't just to sell, it's to maximize the wealth you build. And that means maximizing your valuation multiple through intentional design. And here's where it gets really interesting, where this 70% secret comes in. We always talk about valuation in terms of EBITDA multiples.
Yeah.
And this is where that idea of same financials, double the exit value becomes a reality. The difference between, say, a 4x multiple and an 8x multiple for the exact same level of profit. I mean, that's the difference between an 8-figure net worth and a high 9-figure net worth.
And that difference is the intangible value. It's the transferability factor we're talking about. The fact is, 70% or more of your total business value comes from intangible capital.
70%.
It doesn't show up neatly on a balance sheet. You don't file it as a hard asset. But it is what drives a buyer's confidence, de-risks the whole transaction, and secures their future cash flow.
Okay, let's put some hard numbers on that for everyone listening. Let's say you have a business doing, what, 15 million in revenue and 3 million in EBITDA.
Okay, perfect example. If that business has weak intangibles, it's highly reliant on the owner, lacks documented processes, has major customer concentration risk, it's seen as high risk. A buyer might only offer a 3x or 4x multiple.
So at 4x, that's a $12 million valuation.
12 million. Now, take that same business, same revenue, same 3 million in EBITDA, but this one has strong intangible capital. It's systematized, has a leadership team, recurring revenue, protected IP. It's a low-risk, transferable asset.
Okay.
That business can command a 6x, a 7x, even an 8x multiple. At 8x, you're looking at a $24 million valuation.
Like $12 million difference.
A $12 million difference in your net worth. Same exact profit, double the exit value.
Wow.
And that massive financial implication is why this mindset switch from operator to asset engineer is so critical to make today.
So that's our mission in this deep dive. We want to help you transform from that operator mindset, trapped in the chaos being the bottleneck, to an asset mindset.
Systematized, documented, transferable.
Creating immense optionality for your future. To do that, we are diving deep into the exit readiness framework, the 8 intangible capitals, to show you precisely where that 70% of value is created and how you can start building it right now. That urgency is completely justified by those valuation numbers alone. $12 million on the line for the same profitable business. So we're not talking about, squishy feelings or management fads here. We're talking about tangible, definable assets, these 8 intangible capitals that buyers can literally measure and score. So let's get into the framework.
Absolutely. Think of these 8 capitals as the fundamental non-financial foundations of your business's value, of its transferability. If these 8 pillars are strong, the business is seen as an institutional machine that can run without the owner.
And if they're weak?
If they're weak, the business is frankly a glorified self-employment scheme that just happens to pay really well.
And crucially, we can measure them. This isn't just theoretical. This gives you an actual action plan.
Correct. We use an assessment mechanism. Each capital can be scored on a 1 to 5 scale, and this gives you a brutally honest look at your risk profile.
So what do the numbers mean?
A score of 1 is a critical weakness. This is a major high-priority risk. A buyer sees this, and it's either an immediate deal breaker or they're going to demand a huge discount.
Okay.
A score of 3 is adequate. You meet basic standards, you're doing okay, but you don't have a competitive advantage. You're not premium.
And a 5.
A score of 5 is exceptional strength. This is a true competitive advantage. It's a high degree of transferability. This is what justifies that premium multiple we talked about.
So the mandate is pretty clear then. Find the 1s and 2s and fix them immediately. They're your biggest levers for creating wealth.
That's it.
So let's start with the one that gives most owners trouble, because it's tied directly to that operator mindset.
That would be capital #1, human capital. It's the capability, the transferability, and the retention of your team. It's the ultimate transferability test, and it's probably the first thing a serious buyer really digs into.
And the buyer's question here is pretty straightforward and unforgiving, right? Can the business survive, scale, and generate its current revenue without the current owner?
Precisely. In a weak profile, so a score of 1 or 2, you, the owner, are the chief bottleneck. You're the primary decision maker, the only person who can solve high-level problems, the only one who closes the big deals.
Right.
This profile has high employee turnover because good people feel capped by the owner's control. And all the knowledge is siloed. It's just in people's heads, not written down anywhere.
No clear number 2. No documented training. So if you, the owner, leave for 3 months, the whole business just stops.
It grinds to a halt, and the buyer sees that risk immediately. They know if they buy that business, they essentially have to hire 3 key people just to replace the owner, and those people cost money. They take months to onboard, and it just destroys profitability in the short term.
Yeah.
Absolutely. Now let's look at the strong profile, a score of 4 or 5. This is a buyer's dream. It screams institutional quality.
What does that look like?
It means you have a real second-in-command or a stable leadership team that is empowered to make, say, 90% of the daily decisions. Turnover is low because people feel valued, they have clear career paths.
And redundancy?
Crucially, yes. There is cross-training and redundancy in key roles. If the CFO gets sick, someone else can handle payroll because there's a documented process. Buyers love seeing clear succession plans because it guarantees revenue continuity right after the acquisition.
That sounds like a massive shift in control, and I know a lot of owners listening struggle with this. How do I develop a second in command when I'm still running lean? How do I trust someone with my baby?
And that is the pivotal mental block you have to overcome. You have to treat delegation as an investment, not a cost. The improvement steps, they start with removing yourself as the bottleneck, yes, but specifically by documenting decision-making frameworks, not just tasks.
Okay, what do you mean by that?
Define what decisions your number two can make solo, which ones require a quick consultation with you, and which very few still need your final approval.
And that builds trust.
It builds trust and empowers them. And if you want to keep them after you sell, you have to implement retention incentives, equity, performance bonuses tied to non-owner performance to make those key people sticky. You're paying for optionality, and that is a huge step away from the operator mindset.
That's the first pillar, the people. Okay, moving on to capital #2. Social capital. This sounds like networking, but it's deeper than that, right? It's about reputation and how relationships actually work in the market.
It is. It's all about whether your relationships are transferable. The buyer's question is critical here. Is the business's reputation tied to you, the owner, personally? Or is it tied to the company itself as an independent entity?
Because that determines if your whole network walks out the door with you.
Exactly. I picture that classic founder, who's been the face of the business for 20 years, always speaking at conferences, has all the key contacts in their personal cell phone.
Uses personal charm to open doors.
Right. And that sounds great on a sales call, but for a buyer, that is a massive liability. That's a weak profile, a score of 1 or 2. When all the relationships with industry leaders, regulators, key partners are personal to the owner, the business has no independent presence. The reputation is fragile. It's totally owner-dependent. A buyer sees no strategic alliances they can actually rely on contractually.
So the value of that network just vanishes the moment the owner retires.
Poof, gone. A strong profile, a 4 or 5, means the company brand is recognized, maybe even famous, completely independent of the owner's charisma. The brand itself carries the reputation.
And the relationships are structured differently.
Yes. You see strong industry partnerships and alliances that are structured contractually, not based on a friendship or a golf game. The referral networks are built around the company's performance and its brand authority.
So how do you fix this? How do you depersonalize it?
You have to intentionally transition that relationship ownership. You start introducing your key team members to those contacts. Make it clear they are the future point of contact. You invest heavily in company-level brand presence content, case studies, certifications, things that demonstrate institutional stability. The goal is to make the logo, not the person, the point of trust. Now, let's talk about one of the fastest ways to absolutely destroy a valuation multiple, even faster than a weakness in human capital. Okay. Capital #3, customer capital. This is pure, unadulterated risk mitigation related to your client base.
Right. And the buyer question here is the ultimate test of resilience. Is your revenue concentrated in a few clients, creating a single point of failure? Or is it diversified, recurring, and loyal to the brand?
Concentration risk is the silent killer. A weak profile, a 1 or 2, is defined by that glaring statistic. 1 or 2 customers making up 30% or more of your total revenue.
Oof.
If a potential buyer sees this, they instantly discount the entire business. Because if that one client walks away after the deal closes, the buyer has lost a huge chunk of their investment overnight.
And it's not just concentration, right?
No. This profile also has high churn rates, transactional one-time sales, and customers who are clearly loyal only to the owner. Maybe they follow their personal discounts or guarantees.
That 10-15% rule for customer concentration, no single client over that limit, that's a really critical line for buyers, isn't it?
It is absolutely critical. It signals stability. A strong profile, a 4 or 5, shows extreme diversification. No single customer over that 10-15% mark. They have a high retention, ideally 80% or more annually, and they've built a recurring or subscription-based revenue model.
So the loyalty is to the brand experience, not the founder.
Exactly, and they're tracking satisfaction metrics like Net Promoter Score religiously.
This is where we need to bring in the financial side you mentioned earlier. How does this customer capital score directly translate into a higher EBITDA multiple? We're talking metrics like CAC and LTV.
This is where the intangible becomes very, very tangible. If you score a 5 in customer capital, it means you have high lifetime value. Or LTV, your customers stay longer and spend more. And you have a low customer acquisition cost, or CAC. You get them efficiently through proven systems, not the owner's personal Rolodex.
And a buyer is fundamentally buying future cash flows.
That's all they're buying. If they see a long LTV and a great LTV to CAC ratio, ideally 3-to-1 or better, they know they can pour capital into that machine and get a predictable return. It completely de-risks their investment.
A score of 1, on the other hand.
A score of 1 means high CAC because you're relying on personal selling, and low LTV because customers churn. The growth engine is totally unpredictable. That risk gets immediately factored into a lower multiple. Every time.
So the improvement steps are clear. Aggressively diversify your customer base, convert transactional sales into recurring revenue retainers, subscriptions, long-term contracts, and crucially, transition those personal owner-customer relationships to professional account managers who are supported by a robust CRM system that captures all that data. You have to measure LTV and retention. Those numbers are the lifeblood of your multiple.
Couldn't have said it better.
Okay, moving to the operational side. We hit capital, #4. Supplier Capital. This is all about supply chain resilience, which has become a huge headline risk for buyers, especially lately.
Resilience is the perfect word. The buyer question is the business dangerously dependent on a single supplier? Is there a single point of operational failure that a new owner couldn't fix? Post-COVID, buyers are hyper-aware of this.
A weak profile, 1 or 2, is pretty easy to spot. Total reliance on 1 or 2 key suppliers.
Or maybe having informal, personal relationships with those suppliers that aren't contractual. If the owner leaves, or if that supplier has a hiccup, a fire, a strike, or just decides to jack up prices, the business grinds to a halt. No contingency plan at all.
I'm picturing a manufacturing business where the owner gets 80% of a critical component from a small shop run by his cousin based on a handshake.
That's a 1. That is a solid 1. A strong profile, a 4 or 5, demonstrates multiple tested suppliers for all critical inputs. They have long-term contracts or preferred pricing agreements in place that are structured to transfer with the business.
And they have backups.
They've identified and ideally tested backup suppliers. That mitigates external shocks. It guarantees operational continuity and gives them leverage against price increases.
So to improve, owners have to diversify that supplier base, even if it's a little more expensive. It eliminates that single point of failure.
You're buying operational security. And you have to negotiate those long-term transferable agreements and depersonalize the relationship by getting your purchasing or operations team involved. Let the contracts, not the personal rapport, drive the partnership.
Let's talk about something truly intangible that everyone thinks they have, but very few truly build. Capital, #5. Brand capital. This is more than a logo. It's about defensibility, positioning, and market equity.
It is the moat around your castle. The buyer question is the brand defensible, legally protected and valuable, independent of the owner's name or reputation? If you sell a generic service under a generic name, you have no value outside your profit numbers. You have no bargaining power.
So a weak profile, a 1 or 2, would be a generic or unknown company name. No clear differentiation from competitors. You're just one of many.
And often, critically, you're lacking registered IP protection for your name, your marks, your methods. The brand is inseparable from the owner's personal reputation.
Or your company name is constantly mistaken for a competitor.
Yes. Buyers want to know that the market perception will survive the sale. A strong profile, a 4 or 5, is a recognized brand with clear, defensible market positioning. All trademarks, domain names, any proprietary IP, it's all registered and legally protected.
And the brand identity is consistent.
Consistent across all platforms, and the value exists whether the founder gives a speech next week or not. The brand itself commands premium pricing.
The key improvement step here seems to be professional investment. Owners often hesitate to pay legal fees for IP protection or to hire branding professionals.
They do, but that is the difference between a name that can be easily stolen or copied and an asset that can be defended in court. You have to invest in professional brand development and IP registration. Build company-level brand presence-focused content, high-quality case studies, verifiable industry awards that showcase the company, not just the individual. That's how you build equity a buyer will pay a premium for. They're buying exclusivity. Next, we move into the internal plumbing of the company with capital #6, structural capital. This is all about organizational design, governance, and accountability. It's the blueprint of the machine.
The buyer question here is essential for any kind of integration. Are roles and decision-making documented and structured, or is the business run on chaos and the owner's gut feelings?
Chaos is a clear one or two. The weak profile is the owner making 95% of all decisions. There's no clear reporting structure, roles are informal, they're constantly overlapping.
And firefighting is the daily norm.
It's the norm. There's no governance, no formal board meetings, no outside accountability. Often the financials are sloppy. Buyers see this and know they're inheriting a managerial mess that they will have to spend years and a ton of money fixing before they can even think about scaling.
A strong profile, a 4 or 5, is designed for scale. It has institutional credibility.
You have a clear, up-to-date org chart with defined roles, written job descriptions, and quantifiable key performance indicators or KPIs for every single position.
Not just for the sales team.
For everyone. From sales to operations, there are regular structured leadership meetings, a documented reporting cadence, and often an advisory board that provides checks and balances. The business just looks and feels like a professional operation, not a startup hustle.
I'm picturing that owner who's currently making every $50 decision, constantly getting pulled into low-level conflicts. How much money does that chaos actually cost the business every day?
Millions, not just in lost opportunity, but in an actual reduced valuation multiple because the buyer sees the cleanup cost. The steps to improve this capital start with radical clarity. Create and publish that org chart, write job descriptions, and set objective KPIs that are measurable.
And get some outside accountability.
Yes, even if you're a small team, forming a non-fiduciary advisory board provides immediate outside perspective and it makes the business feel more institutionalized to a buyer. It proves governance exists outside the founder's head.
This leads perfectly into capital #7, operating systems capital. We often call this the knowledge base. So structural capital is defining who owns the quarterly budget.
Right, the blueprint and the roles.
But operating systems capital is the documented step-by-step process of how that budget is prepared, reviewed, and finalized.
An excellent distinction. Structural is the hierarchy. Operating systems are the functional instructions. The buyer question. Can a new person step in and run the core functions of this business based on written processes? Or is execution dependent on tribal knowledge and just luck?
If everything is in the owner's head, or if experienced employees just know how we've always done it, that's a weak profile, a 1 or 2.
There's high variability in quality because everyone does things a little differently. New hires struggle because nothing is documented, and training just means shadowing the one person who knows the secret system.
And that tribal knowledge is a huge obstacle to scaling and transferability.
It's a wall.
But I want to push back for a second. For a smaller, growing company, that tribal knowledge, it allows for flexibility and speed. Why should a busy owner slow down to write a 50-page SOP manual when they know their business best?
Because you are sacrificing millions in future valuation for marginal short-term speed. The buyer is paying for consistency. The strong profile, a 4 or 5, has core processes documented as standard operating procedures, SOPs, playbooks, checklists that govern key outcomes.
And the systems are integrated.
Systems are integrated for all key functions. A CRM for sales, project management for delivery, established accounting software for finance, and the processes are regularly reviewed and updated by the team, not just the owner. A buyer can look at this and see a highly reliable machine that produces results consistently no matter who is operating it.
So the improvement steps mandate documentation as a cultural necessity.
Exactly. Start small. Focus on the 3 most painful or frequent processes: closing a sale, onboarding a new client, whatever it is. You don't need to build an enterprise-level intranet on day 1.
Just start.
Just start with a simple tool like Notion or a shared Google Doc to house your core SOPs. Make documentation a cultural mandate. It's a process improvement, not a chore. This is what transforms variability into reliability, and reliability is transferable value.
Finally, we get to capital #8, digital capital. In today's world, this is arguably the fastest growing part of that 70% intangible value. Technology, data, digital assets, they're the engines of future growth.
Agreed. The buyer question is simple. Does the business possess valuable modern digital assets and technology that drive future revenue and are scalable?
A weak profile, a 1 or 2, is a business running on clunky, outdated, scattered technology. Maybe they're still using desktop software that can't be accessed remotely.
Or they have an outdated website that doesn't generate any leads. limited or non-existent online presence, no valuable proprietary data or digital IP. They aren't generating leads digitally, they're just relying on referrals. This screams high integration risk for a buyer.
Conversely, a strong profile, a 4 or 5.
A strong profile has proprietary software, unique tools, or high-value structured data that provides a competitive moat. They have a strong, active, and lead-generating online presence, good SEO, targeted social media, a large, engaged email list.
And their data is an asset.
Their data, customer history, behavioral data is clean, organized, and potentially monetizable. Their tech stack is modern, it's cloud-based, it's highly scalable, meaning a buyer can easily integrate it into their own systems.
So the action plan here is to invest strategically. Hire a professional firm for a website redesign and focus on aggressive SEO to build that inbound channel. Build those valuable digital assets like email lists and social media presence, because the list itself is an asset, and modernize the tech stack to cloud-based systems. Protecting and organizing customer data is a form of IP that buyers will pay a premium for because it enables immediate data-driven growth right after the acquisition. We've just mapped out the entire exit readiness framework: human, social, customer, supplier, brand, structural operating systems, and digital capital. 8 pillars that define 70% of your net worth potential.
And you can see exactly how a weakness in one area destroys value and a strength in another secures that higher multiple.
So now we have to put this into action. This is the empowering call to self-assessment.
This is the moment of truth. This is where you stop being the operator for a minute and start being the engineer of your own wealth. We challenge you, the listener, to use these 8 capitals. Score your business honestly right now on that scale of 1 to 5 for each category.
And don't be kind. Be brutally realistic about what a third-party buyer's due diligence team would actually see.
Exactly. Remember that 1 is not just bad, it's a critical weakness that needs immediate attention. A 5 is a real competitive advantage that secures a premium.
So take a moment for each of those 8 capitals and assign your score based on the profiles we just detailed.
And then you tally your total score. The maximum potential is 40 points. This total score provides an instant, quantifiable reality check on your company's overall transferability and risk profile, and that directly correlates to the valuation multiple you can get.
So what does that final number mean for your 8-figure goal? Let's interpret the score and give everyone a financial roadmap back to that 3x versus 8x multiple.
Okay. If your total score is 3240, exceptional, you are in the top tier. Your business is highly transferable, significantly de-risked, and should command a premium multiple, that 6x to 8x EBITDA range we talked about. Buyers see institutional quality and low integration risk. They know they can step in, plug in their capital, and just accelerate growth instantly.
What about the next level down? If you scored, say, 2431, strong.
You're on a great track. You have a lot of good systems, but refinement is needed. You probably have a couple of areas scoring a 3 or 4 that need to be pushed into that 5 zone. You'll be in the 5x to 6x multiple range, but those remaining weaknesses might trigger an escrow or some clawback clauses if you don't address them.
And if you're in the middle, 1623, average.
This means you have significant work to do to engineer the asset. You're profitable, yes, but your dependence on the owner and your structural chaos are preventing maximum value. You're likely scoring a lot of 2s and 3s. This is the range where you're looking at a 4x or maybe a 5x multiple, but it's highly contingent on fixing immediate risks during due diligence.
And the high-risk zones, 815, weak.
Yeah.
This is the crisis zone.
If you fall into this zone, your business is at serious risk of being unsellable in its current state. You have critical weaknesses, multiple 1s and 2s, that scream that the business relies too heavily on you. A buyer will likely pass entirely or offer a distressed price, like a 3x multiple or lower, because they see the post-acquisition fix-up as prohibitively expensive. This is the zone where owners discover they built a job, not an asset, when it's far too late.
But the good news here is that you don't have to fix all 8 capitals at once.
No.
The focus strategy is key to avoiding panic and driving the most immediate value increase.
Precisely. Do not try to boil the ocean. Look at your lowest scoring capitals first. If you scored a 1 in human capital and a 2 in customer capital, those are your immediate priorities. These weaknesses are not just risks, they're your biggest opportunities to immediately jump your valuation multiple.
Because fixing a 1 is far more impactful than improving a 4 to a 5.
Far more financially impactful. Focus on eliminating the red flags and the market will reward you for de-risking the asset.
This process, this is the ultimate empowering action. It is not about preparing for a hypothetical exit 3 years from now. This is the act of building the highest possible net worth vehicle today.
Hmm.
It transforms your daily operational decisions, like documenting an SOP or hiring a number two, into long-term strategic investments in your own future wealth and your own optionality.
Every SOP you write, every key leader you hire, every contract you document is a brick in the foundation of that 8 or 9-figure net worth you're aiming for. That's the high-stakes reality, but it's an achievable one when you shift your focus to transferability.
That brings us to the end of this deep dive into the 70% value secret, providing you with the framework to assess your true transferability. Let's quickly recap the key takeaways.
Remember this, above all else. 70% of your business value resides in these 8 intangible capitals, not just your raw financial statements. We've given you the tools to see that the difference between a $12 million exit and a $24 million exit is entirely within your control.
And we broke down those 8 pillars of transferability, which basically serve as the due diligence checklist for any serious buyer.
Human capital. Can your business run without you?
Social capital. Does the reputation belong to the company or to you?
Customer capital. Is your revenue diversified and recurring?
Supplier capital. Is your supply chain resilient?
Brand capital. Is your brand defensible and protected?
Structural capital. Is your company designed for scale?
Operating systems capital. Is your knowledge documented?
And digital capital. Do you have valuable, modern tech and digital assets?
We've given you the challenge. Score yourself 1 to 5 on each capital to immediately identify those massive gaps that are actively suppressing your valuation multiple.
And the provocative final thought for you to chew on today is this. The single most important decision you can make in your business today is deciding whether you are running a job or engineering an asset. You may be making great money right now, but unless you address those ones and twos in your capital structure, you are working harder than you need to, and you are actively costing yourself millions in potential net worth.
Wealth creation is intentional design, not accidental profit.
And that intentionality starts today by focusing on your lowest score. Okay, let's unpack this even further. You now know what creates 70% of the value. You have the framework. In our next deep dive, we're moving directly from framework to finance. We will show you how to calculate your business value and engineer a higher multiple.
Specifically, we'll break down exactly how those strong intangible capitals directly increase your valuation multiple through the eyes of a financial analyst. We will drill down into the unit economics that drive value, diving deep into how to calculate and improve customer acquisition cost, CAC, and lifetime value, LTV.
And we'll walk through real valuation scenarios that show you exactly how to move from that risky 3x multiple to the premium wealth-generating 8x multiple.
That's right.
Stay tuned to continue transforming your business into a massive, transferable wealth engine. Thank you for diving deep with us. We'll see you next time.